Ladies and gentlemen, Asian guy here, and if you're watching this, you probably felt it. That sudden drop, that fear, that moment when Bitcoin fell and every chart turned red, and I'm going to tell you something right now that might sound controversial. That wasn't organic. That wasn't natural market behavior. That wasn't retail suddenly deciding to sell. That was triggered deliberately, strategically, and the proof isn't in the price. It's in the liquidity, because while everyone was watching the candles, the real story was happening in the order books. Now, before we go further, still let me be clear about what I mean by liquidity. I'm not talking about volume. I'm not talking about market cap. I'm not talking about how many Bitcoin exist. I'm talking about the depth of the order book, the actual buy and sell orders sitting there, waiting to be filled, the cushion that absorbs selling pressure. And when that cushion disappears, even small orders can move price violently. That's what happened. And it wasn't an accident. Let me paint you a picture of what the market looked like before the sell-off. Bitcoin was trading around key resistance. Price was consolidating. Everyone was watching, waiting for the breakout. But if you looked at the order books, if you looked at the actual liquidity profile, you'd see something concerning. The bid side was thin, unusually thin, and the ask side stacked layer after layer of sell orders. Now, here's what most people don't understand. Order books aren't static. They're dynamic. They can be manipulated. Market makers can pull liquidity in seconds. Algorithms can flood one side while starving the other. And that's exactly what happened. In the hours leading up to the drop, bid liquidity started disappearing. Not slowly, not gradually, rapidly. Major buy orders that had been sitting below price suddenly canceled. The support that traders were relying on vanished. And when support vanishes, price has nowhere to go but down. That's not fear, that's mechanics. Because here's the thing about liquidity. It's the foundation of price stability. When liquidity is deep, large orders barely move price. When liquidity is thin, small orders can trigger cascades, and someone knew exactly when liquidity would be thinnest. Let me show you the timeline. 11:47 p.m. UTC, bid liquidity on major exchanges drops by 40%. No news, no event, just gone. 11:52 p.m. UTC. A series of large sell orders hit the market, not market orders that would execute immediately. Limit orders placed just above the current bid, designed to create a wall. 11:58 p.m. UTC. Price starts dropping, first 2%, then 5%. Then the cascade begins, stop losses trigger, liquidations fire, panic spreads, and through it all, liquidity remained thin because it was being kept thin deliberately. Now let's talk about who benefits from thin liquidity, because that's the key to understanding this entire move. When liquidity is deep, moving price is expensive. You need massive capital to push through all those orders, but when liquidity is thin, you can move price with relatively small amounts. It's efficient, and efficiency is what professional traders seek. So if you're an institution and you want to accumulate Bitcoin, but you don't want to pay current prices, what do? You don't just place a massive buy order. That would push price up. You create conditions where sellers come to you, and thin liquidity creates those conditions perfectly. Here's how it works mechanically. Step 1, pull your bid liquidity. You're a market maker. You have orders sitting in the book. You cancel them. Now the book is thinner. Step 2, place strategic sell orders, not to actually sell, but to create the appearance of resistance. Price sees a wall. Momentum stalls. Step 3, wait for impatience, because markets hate uncertainty. When price isn't moving, traders get nervous. They start closing positions. Those closes become sells. Step 4, let gravity work. Once selling starts, thin liquidity amplifies the move. Each sell pushes price lower, which triggers more sells, which pushes price even lower. It's a cascade, and cascades always overshoot. Step 5, absorb at the bottom. When panic peaks, when everyone is selling, that's when you buy. Quietly, patiently, methodically. Now let me show you the evidence, because this isn't theory. This is visible in the data. If you look at order book snapshots from major exchanges, Binance, Coinbase, Kraken, Bitstamp, all showed the same pattern. Before the drop, bid depth at 97,000 was approximately $180 million across all exchanges. Not bad. But then, in the span of 15 minutes, that dropped to $68 million, 62% reduction. No explanation, no news, just gone. And on the ask side, sell orders increased by 40%. So you had less support and more resistance. Price had only one direction to go. But here's where it gets really interesting. During the actual drop, when price was falling most violently, when panic was highest, bid liquidity started returning, not at the top, at the bottom. Orders appeared at 92,000, at 90,000, at 88,000. Large orders, the same size that had disappeared from 97,000. No, that's not coincidence. That's strategy. Someone pulled liquidity from the top and placed it at the bottom. They manufactured the drop, and they caught the bottom, all in one coordinated move. Now let's talk about the timing, because timing reveals intent. This move happened during Asian trading hours, 2 a.m. in Tokyo, 3 a.m. in Hong Kong, 4 a.m. in Singapore. U.S. markets closed, European markets closed, liquidity naturally lower, perfect conditions, but it gets better. The move happened on a Sunday. Weekend trading, even thinner liquidity, and it happened right before a major options expiry. Billions in open interest. All of that is visible. All of that is public information. And someone used all of that to their advantage. Let me explain why options expiry matters, because this is crucial to understanding the full picture. When options are about to expire, market makers who sold those options need to hedge their positions. If they're short calls, they need to sell as expiry approaches. If they're short puts, they need to buy as expiry approaches. But here's the thing. Market makers don't want to lose money, so they manipulate price toward levels where most options expire worthless. It's called pinning, and it happens every single expiry. In this case, most call options were struck at 100,000 and above. Most put options were struck at 95,000 and below. So where did price need to go? Somewhere in between. Specifically, somewhere that causes maximum pain for option buyers and minimum loss for option sellers. Price dropped to 94,000, just below the major put strikes, triggering those puts, but not low enough to stay there, because staying there would require market makers to actually pay out. So price bounced back quickly, to around 96,000, right in the dead zone where most options expired worthless. Coincidence? Now let's talk about what happened after the drop, because this is where the liquidity story gets even more revealing. Within 6 hours of the bottom, Bitcoin had recovered 60% of the drop, fast, violent rebound, and if you looked at the order books during that recovery, bid liquidity was massive. All the orders that had disappeared, suddenly back, and the ask side, thin. The exact opposite of before the drop. Someone flipped the script. They pulled bids to create the drop. They pulled asks to create the recovery. That's not market sentiment. That's market engineering. Let me give you the numbers, because numbers don't lie. During the drop phase, total sell volume across major exchanges, approximately 4.2 billion. Sounds like a lot. But here's the thing. Of that 4.2 billion, only about $800 million was actual spot selling. The rest, derivatives liquidations, forced selling, people getting liquidated from leveraged positions. They didn't choose to sell. They had to sell. And who was on the other side of those sells? Not other retail traders. Institutions, market makers, the same entities that pulled liquidity in the first place. They created the sellers, and they absorbed the selling. It's a perfect cycle. Now let's compare this to organic sell-offs, because there's a clear difference. In an organic sell-off, liquidity remains relatively stable. Both sides of the book stay active, because real fear takes time to build. People don't all decide to sell at once. They hesitate. They hope. They wait for a bounce. That creates choppy price action. Multiple attempts to recover, multiple failures, slow degradation. But in this sell-off, price fell in a straight line. No hesitation, no bounce attempts, just down. That's mechanical, not emotional. And the recovery, just as fast, just as mechanical, because once the liquidity returned, price had nowhere to go but up. Here's what really happened. And I'm going to lay this out step by step, because once you see the structure, you can't unsee it. Phase 1, setup. Market makers identify crowded positioning, over-leveraged longs, predictable stop-loss levels. They calculate exactly how much selling pressure would be created if price dropped to specific levels. They run the numbers. Phase 2, preparation, slowly reduce bid liquidity, Not enough to trigger immediate panic, just enough to thin the book, place strategic sell walls, create the appearance of resistance, make traders nervous. Phase 3. Execution. Pull remaining bid liquidity. Price has no support. Execute coordinated sells, not massive, just enough to start the move. Let physics take over. Thin liquidity amplifies the move. Stop losses trigger. Liquidations cascade. Panic spreads. Phase 4. Absorption. Place massive bids at predetermined levels. Absorb all the panic selling. Accumulate at discounted prices. Phase 5. Recovery. Restore bid liquidity. Pull ask liquidity. Let price recover naturally. Profit from both directions. Now let me address what you're probably thinking. Isn't this manipulation? And the answer is, it depends on how you define manipulation. Is it coordinated? Yes. Is it strategic? Absolutely. Is it illegal? No. Because here's the thing. Crypto markets are largely unregulated. There are no rules against pulling liquidity. There are no rules against coordinated trading. There are no restrictions on market-making strategies. It's the Wild West. And in the Wild West, the fastest guns win. But here's what makes this even more interesting. This wasn't just one entity. This was multiple players, all reading the same signals, all seeing the same crowded positioning, all executing similar strategies, simultaneously, because in modern markets, algorithms see opportunities instantly. High-frequency trading firms, quantitative funds, market-making desks, they all run similar models, they all identify the same inefficiencies, and they all execute at the same time. It's not conspiracy, it's convergence, multiple players, independent decisions, same conclusion. That's what makes it so effective and so predictable. Now let's talk about the clues, because if you know what to look for, you can see these moves coming. Clue 1, bid-ask spread widening. When the spread between best bid and best ask starts expanding, it means liquidity is being pulled. Market makers are stepping back. Volatility is coming. Clue 2, order book depth declining. Look at the total value of orders within 1% of current price. If that number drops significantly, without corresponding news, someone is preparing something. Clue 3, volume profile shifting. When you see volume increasing on the ask side, but decreasing on the bid side, that's a signal. Resistance building, support weakening. Clue 4, funding rates staying elevated. When funding rates remain high, despite price consolidating, it means positions are crowded, and crowded positions are vulnerable. Clue 5, options open interest concentration. When you see massive open interest at specific strikes, especially near expiry, price will be drawn toward max pain, like gravity. All of these clues were present before this drop, every single one. But most people weren't looking. They were watching price, while the real story was in liquidity, and that's the lesson here. Price is just the result. Liquidity is the cause. If you want to understand where price is going, don't watch the candles, watch the order books. Now let me show you what happened to different types of traders, because the impact was not equal. Retail traders with stops at obvious levels liquidated. They sold at the absolute worst prices, because their stops were exactly where the drop was designed to hit. Retail traders without stops held, watched their positions go deep red, experienced maximum emotional pain, but didn't sell. Leveraged traders destroyed, positions liquidated automatically, no choice, maximum loss. Professional traders watching liquidity, profitable. They saw the setup, they anticipated the move, they positioned accordingly. Some even profited both directions. Institutions with patient capital accumulated, they absorbed the panic selling, added to positions at discounts. This is how wealth transfers, from those who trade emotion to those who trade structure. Let me give you a specific example. A retail trader bought Bitcoin at 98,000, set a stop loss at 95,000, just in case. Thought he was being responsible. When price dropped to 95,000, his stop triggered, sold at 95,000, loss 3,000 per Bitcoin. Price immediately bounced back to 90,600. He watched from the sidelines, frustrated, confused, defeated. Meanwhile, an institution placed a massive bid at 90,400, absorbed millions in selling, bought what retail was forced to sell. Price recovered to 96,500. They're up 2,000 per Bitcoin. In 6 hours, same market. Different understanding, different outcome. Now let's talk about what this means going forward. Because this isn't the last time this will happen. It's a pattern. And patterns repeat, especially profitable patterns. So the question is, how do you protect yourself? How do you avoid being the liquidity provider? How do you avoid being the exit liquidity? First, understand leverage is a trap. Leverage amplifies gains, but it guarantees you'll be targeted because your liquidation level is visible. It's in the data, and that data is used against you. Second, don't place stops at obvious levels, round numbers, previous support, moving averages. Everyone puts stops there, which means that's exactly where price will be driven. Third, watch liquidity, not just price. Use tools that show order book depth, monitor bid-ask spreads, track market maker behavior. Fourth, understand timing matters. Low liquidity hours, weekends, holidays, that's when these moves happen. Be extra cautious during those times. Fifth, build conviction through research, not through price action. Because if you understand fundamentals, volatility becomes opportunity, not threat. Here's the uncomfortable truth. These engineered moves aren't going away. They're becoming more sophisticated, more algorithmic, more efficient, because the players executing them are getting smarter, their systems are getting faster, their coordination is getting better. And retail is still watching candles, still placing stops at obvious levels, still trading with emotion. Nothing has changed. That's why these moves keep working. But here's the opportunity, and once you understand the game, you can play it differently. You stop being the target and start being the beneficiary. Because every violent drop creates discounted entry points. Every liquidation cascade transfers coins from weak hands to strong hands. Every engineered sell-off sets up the next leg up. That's not optimism, that's structure. Markets need to cleanse leverage before they can rally sustainably, and the more violent the cleansing, the stronger the rally that follows. Let me leave you with this. The next time Bitcoin drops violently, don't panic, ask questions. Where's the liquidity? Who's on the other side? What's being triggered? Is this forced selling or voluntary selling? Because those questions will tell you everything you need to know about whether this is a trap or a real breakdown. And 90% of the time, it's a trap. They triggered the sell-off. But liquidity told the real story, and now you know how to read it. The bid side thinning, the ask side stacking, the timing being perfect, the recovery being mechanical. That's not random. That's not organic. That's engineered. And once you see it, you can't unsee it. So the next time everyone is panicking, you'll be watching the order books, and you'll know exactly what's happening. While everyone else is just reacting, you'll be understanding. And in markets, understanding is the only edge that matters. Because what looks like chaos to most is just choreography to those who know where to look.